3 weeks ago, I got a call at 6 a.m. It was a fund manager I've known for 20 years. He manages $2 billion for pension funds and university endowments. Smart guy, former Goldman Sachs, not prone to panic. But his voice was shaking. "Ray," he said, "I don't know what to do. Trump just announced another round of tariffs. My portfolio is getting destroyed. Steel companies up 40%, retailers down 25%, tech stocks swinging 10% a day. I've got redemption requests coming in. I can't predict what happens next week, let alone next quarter. What the hell am I supposed to tell my clients?"
I told him the same thing I'm going to tell you right now. Stop thinking about this as a trade policy issue. This is a debt supercycle colliding with rising nationalism and the end of globalization. And Trump's tariffs aren't just bad economic policy. They're the accelerant that will burn down 80 years of American financial dominance. Let me be direct. We're living through the highest tariff rates America has imposed since 1941. The average U.S. tariff jumped from 2.5% in early 2025 to 27% after Trump's Liberation Day on April 2nd. We're talking 145% cumulative tariffs on Chinese goods, 46% on Vietnamese products, 10% baseline on virtually everything else coming into this country. This isn't a negotiating tactic. This is economic warfare. And like all wars, there will be massive casualties. I've studied every major empire collapse over the last 500 years. Rome, Spain, the Dutch, the British, they all followed the same pattern. Overextension, massive debt, loss of economic competitiveness, desperate attempts to maintain dominance through force rather than mutual benefit. And it always ends the same way. The reserve currency collapses, the empire contracts, the standard of living falls. We're watching that pattern play out in real time. And Trump's tariffs are accelerating every stage.
Here's what I'm going to walk you through. First, where we are in the long-term debt cycle and why tariffs are the worst possible policy at this exact moment. Second, the geopolitical earthquake happening underneath that nobody's talking about. Third, the specific companies and sectors getting destroyed right now. Fourth, the sequence of events that unfolds if these tariffs persist. And finally, how to position yourself before the wave crashes.
Let me tell you about a meeting I had in September 2008. I'm sitting in a conference room with Treasury officials, Fed governors, and some of the smartest economic minds in the country. Lehman Brothers just collapsed. AIG is next. The question on the table, how do we prevent complete systemic collapse? The answer everyone arrived at? Print money, massive amounts, and export the inflation to the rest of the world through the dollar reserve system. It worked because the world had no choice. They needed dollars to trade, to buy oil, to hold reserves. They had to absorb our inflation. But here's what I learned in that room that day. This wasn't a solution. It was a delay. We were kicking the can down the road and making the eventual reckoning much, much worse. Fast forward to today. We didn't deleverage after 2008. We added more debt. Then COVID hit, and we printed trillions more. The M2 money supply expanded 40% in 2 years. The U.S. national debt is now $36 trillion and climbing $1 trillion every 100 days. We're running trillion-dollar deficits in a supposedly strong economy.
This is late-stage debt cycle behavior. And it only works as long as the world keeps accepting dollars. Trump's tariffs are destroying that arrangement. Here's why this matters. When you impose 145% tariffs on your largest trading partner, you're not just raising costs. You're telling them, we don't need you. And when you tell the world you don't need them, they start asking, do we need you? China is asking that question. So is Europe. So are our traditional allies. And the answer they're coming to is terrifying. Let me give you a specific example. In 2020, China settled 2% of its global trade in yuan. By 2025, that number hit 28%. 28%! Meanwhile, the dollar's share of global trade settlement dropped from 88% to 64% in just 5 years. That's not a trade statistic, that's a seismic shift in monetary power. And it's accelerating because of tariffs. Every time Trump threatens another round, China accelerates de-dollarization. They reduce treasury holdings. They build alternative payment systems. They establish currency swap agreements with dozens of countries. They accumulate gold at record rates.
I was in Beijing 2 months ago for private meetings. The shift in tone from 5 years ago is dramatic. They're not angry. They're calm, methodical, building alternatives systematically. The digital yuan infrastructure is operational. The BRICS payment rails are functioning. The Belt and Road logistics networks span 140 countries. This isn't reactive, it's strategic. And once these systems are built, they don't go away. You can't negotiate your way back to dominance once you've given countries viable alternatives. Let me walk you through what's actually happening to American companies. Not the theory, the reality, because this is where policy meets your portfolio. I've watched Nike for decades. Smart company, great brand. They spent the last 10 years systematically moving production out of China to avoid Trump's first round of tariffs. Vietnam, Cambodia, Indonesia. Seemed like a smart move. Then Liberation Day hit. Vietnam faces 46% tariffs, Cambodia 49%, Indonesia 32%. Nike manufactures 28% of their goods in Vietnam, 16% in China, 15% in Cambodia. They got hit from every angle.
On April 3rd, Nike stock dropped 14% in a single day. $14 billion in market value evaporated. Their CFO had to announce they're facing approximately $1 billion in additional costs. $1 billion! That's not a rounding error, that's existential. They tried raising prices. Running shoes that were $120 went to $135. But here's the problem. Their competitors, Adidas, Puma, On Running, they all manufacture in the same countries. They all face the same tariffs. So Nike can't gain market share by eating the costs. The entire category just gets more expensive. The consumer loses. Nike's margins shrink. And nobody wins, except maybe domestic steel producers who employ 140,000 people while the retail industry employs 16 million.
Tim Cook has been playing a delicate dance with Trump for years. In February, Apple announced a $500 billion investment in the U.S. over 4 years. Trump loved it, praised Cook publicly, called him a great executive. But when Cook announced they'd shift iPhone production from China to India rather than to America, Trump went ballistic on Truth Social. I expect their iPhones will be manufactured and built in the United States, not India. He threatened at least 25% tariffs on iPhones. Here's the economic reality Cook is facing.
Apple can't just flip a switch and manufacture iPhones in Nebraska. The supply chain is incredibly complex. It took decades to build in China. They source components from Japan, South Korea, Taiwan, Vietnam. Hundreds of suppliers, thousands of subcomponents. A truly American-made iPhone would cost double the current price and take 5 years minimum to establish. Meanwhile, Apple is stuck. They're trying to move production to Vietnam and India to reduce China exposure. But now, India faces 27% tariffs, Vietnam 46%. No matter where they go, they're hit. And every quarter, they're bleeding billions in tariff payments while trying to thread an impossible needle between Chinese manufacturing capacity, Indian labor costs, Vietnamese quality control, and Trump's Twitter threats. I need you to understand something. When Walmart, a company that built its entire business model on everyday low prices, tells you prices are going up, you better believe it. Target gets 30% of their goods from China. They had a catastrophic first quarter. Same-store sales down, profits crushed. Their CFO announced they're evaluating which tariff costs they can absorb and which they must pass to customers. That's corporate speak for, we're going to raise prices and hope you don't notice. Walmart is in the same position. They've spent 50 years optimizing their supply chain to deliver the lowest possible prices. Now they're forced to either destroy margins or destroy their value proposition. They've already announced price increases are coming.
Best Buy faces the worst situation. They get 55% of products from China and 20% from Mexico. Consumer electronics, TVs, computers, smartphones, they're all heavily dependent on rare earth elements predominantly processed in China. Their SEC filing explicitly states they cannot easily swap suppliers without massive disruption and delay. When the tariffs hit, Best Buy stock dropped 18% in 3 days. That's not market volatility. That's investors realizing the business model is broken. Trump imposed a 25% tariff on automobiles in April. Here's what most people don't understand. Not a single 2025 model year vehicle sold in the U.S. gets more than 80% of its content from America. Not one.
Your American car has a transmission from Mexico, chips from Taiwan, steel from Canada, rare earths from China, and final assembly in Alabama. These supply chains took decades to optimize. You can't just move them overnight because a president tweeted. Volkswagen is exploring adding an import fee to U.S.-bound vehicles. Mercedes-Benz and Volvo are looking at boosting U.S. production, but that requires billions in investment and years to implement. And here's the killer question every auto executive is asking. What if I spend $5 billion building a new U.S. factory and Trump's tariffs get struck down by the Supreme Court, or the next president reverses them? That uncertainty is paralyzing, so companies wait. And while they wait, they're paying billions in tariffs every quarter.
Let me walk you through exactly how this plays out. Because this isn't speculation, this is pattern recognition from studying hundreds of historical cases. We're here now. The Tax Foundation estimates $1,300 per household in direct tariff costs for 2025, $1,600 in 2026. But that's just the beginning. When Nike raises prices because of tariffs, New Balance raises prices too. Why? Because they can. Reduced import competition means domestic producers gain pricing power. The inflation compounds. I'm watching consumer sentiment collapse.
The University of Michigan index fell to 57.9, a two-year low. Inflation expectations jumped to 4.9%. People see this coming. They're cutting discretionary spending. Holiday shopping projections are down 8%.
This feeds on itself. Lower consumer spending means slower GDP growth. Slower growth means weaker corporate earnings. Weaker earnings mean lower stock valuations. Companies front-ran tariffs by stockpiling inventory before they hit. Nike rushed shipments. Apple filled warehouses. Best Buy maxed out storage capacity. That's why the S&P 500 inventory-to-sales ratio looks stable in Q1. But that inventory is running out, and replenishment at current tariff rates is unsustainable. The footwear industry sent a letter to Trump signed by 76 brands warning that companies face cumulative tariffs of 150% to 220% on footwear. They called it an existential threat to the industry. Not challenging, not difficult, existential.
Building new supply chains takes years. You need to find manufacturers with capacity, transfer specifications, train workers, validate quality, establish logistics. For a company like Nike or Apple, that's a 3 to 5 year process minimum. Meanwhile, you're bleeding cash every month paying tariffs on existing supply chains. This is coming in late 2025 and 2026. Retailers with heavy import dependence and thin margins will start failing. We're already seeing warning signs. Companies with high debt loads, facing rising costs and falling revenues, can't service their debt? Credit downgrades, defaults, bankruptcies, layoffs. The retailers most vulnerable? Heavy China sourcing, low margins, high debt, weak brand loyalty. I won't name specific companies, but you can run the screens yourself. There are dozens at risk.
Other countries aren't sitting idle. China already imposed 125% retaliatory tariffs before the temporary truce. Canada hit $30 billion in U.S. goods with tariffs. Europe is preparing major retaliation. American exporters get crushed. Boeing, Caterpillar, agricultural equipment, soybeans, aircraft, these are high-value, high-wage export industries. When they lose foreign markets, those are good jobs disappearing. During Trump's first trade war, American farmers got devastated. The government paid $28 billion in subsidies to keep them afloat. This time, the scope is much broader. We're talking about potentially hundreds of billions in lost exports. And every dollar lost in exports is a dollar less demand for dollars globally.
This is the end game, and it's what keeps me up at night. Foreign central banks hold $7 trillion in U.S. Treasury securities. That's $7 trillion worth of trust in American stability and policy predictability. But when America weaponizes trade, when tariffs can change with a presidential tweet, when policy uncertainty makes long-term planning impossible, that trust erodes. Central banks don't dump treasuries overnight. That would crash their own holdings. They do it slowly, reducing new reserve allocations, shifting to euros, yuan, gold. Each decision is small. Collectively, they're massive. Here's the feedback loop that terrifies me. As demand for treasuries falls, yields rise. Higher yields mean higher U.S. borrowing costs. With $36 trillion in debt and trillion-dollar annual deficits, higher borrowing costs mean the deficit explodes faster. Faster deficits mean more borrowing need. More borrowing with falling demand means even higher yields.
This is the debt spiral. And once it starts, it's nearly impossible to stop without severe austerity or currency debasement. When the dollar loses reserve status, America loses the ability to run deficits without consequences. We can't print money and export inflation anymore. We have to balance budgets, cut spending, raise taxes, accept a lower standard of living. For a country that's run trade deficits for 50 years, that adjustment is devastating. So what do? Here's the framework we use at Bridgewater. First, diversify across currencies and geographies. Don't be 100% dollar-denominated. Hold assets in euros, Swiss francs, Singapore dollars. Gold, commodities, real assets that hold value when currency systems shift. Second, own businesses with pricing power and domestic focus. Companies that can pass through costs and don't depend on complex global supply chains. Utilities with regulated returns. Regional banks with domestic deposits. Consumer staples with strong brands like Procter & Gamble, Coca-Cola, Colgate. Third, avoid over-leveraged companies in vulnerable sectors. Retailers with heavy import dependence, apparel, consumer electronics. These sectors are getting crushed. Many companies won't survive. Fourth, hold significant cash. Bridgewater is holding more cash than we have in a decade. Why? Because when this breaks, assets will get cheap, really cheap. You want ammunition to deploy when others are forced to sell. Fifth, watch the leading indicators. Dollar index, treasury yields, trade-weighted yuan, gold prices, corporate credit spreads. These will tell you where we are in the cycle. Right now, the market is in denial. The S&P 500 rallied 26% from April lows because investors think Trump will back down. They call it the taco trade. Trump always chickens out. Maybe. He did pause tariffs for 90 days. He negotiated some rates down. But the baseline 10% remains. The escalating China tariffs remain. Section 232 steel and aluminum tariffs at 50% remain. And even if he backs down completely tomorrow, the damage is done. The world has seen that American policy is unpredictable, that we'll weaponize market access, that our word isn't reliable. You can't unring that bell. I've spent 50 years studying how empires rise and fall. I've analyzed the Dutch Golden Age collapse, the British Empire decline, the Soviet Union implosion. The pattern is always the same: overextension, massive debt, loss of economic competitiveness, desperate attempts to maintain dominance through force rather than mutual benefit. And then the reserve currency collapses, the empire contracts, the standard of living falls dramatically. We're watching the American version of this story unfold in real time. Trump thinks his tariffs are making America great again. He's actually accelerating the end of American financial hegemony. Every tariff he imposes pushes China, Europe, and our allies closer to alternatives. Every threat erodes trust. Every policy reversal proves we're unreliable. The dollar's reserve status isn't based on military power. It's based on trust. Trust that America will honor debts. Trust that our markets are stable. Trust that policy is predictable. Trump's tariffs are destroying that trust, piece by piece, tweet by tweet. That fund manager who called me at 6 a.m. 3 weeks ago, I told him to cut equity exposure by 40%, increase cash to 25%, Diversify 20% internationally and allocate 15% to gold and commodities. He thought I was being too conservative. Last week, he called back. "Ray," he said, "I should have listened harder." I've seen this movie before. I know how it ends. The wave builds slowly, then crashes all at once. Most people won't see it until it's too late. They'll wake up one day and their portfolio will be down 40%. Their currency will have lost 30% of its purchasing power, and their retirement timeline will have been pushed back a decade. You don't have to be one of them. Study the cycles, understand the machine, position accordingly. Because in times of great change, wealth isn't destroyed, it's transferred. From those who don't see it coming to those who do. The machine is breaking down. The wave is building. And you need to decide right now which side of that wave you want to be on. Because I promise you, when it crashes, there won't be time to adjust.